Okay, so you want to mine Bitcoin. Here's how you've probably imagined it. You buy a machine, you plug it in, and it converts electricity into digital money around the clock. Passive income at the speed of computation. The machine works. You collect. The math is right there in front of you. So many terahashes per second, so many Bitcoin per day. Simple. It is not simple. Here's the thing nobody tells you when you're staring at those numbers. Bitcoin mining is not a technology business. It's not a passive income machine. It's a commodity manufacturing operation running inside a race that never stops against competitors you cannot see, governed by rules that were designed deliberately, ingeniously, and with the mechanical precision of a clock to ensure that your advantage never lasts. The machine doesn't print money. It competes for a fixed prize that gets smaller every 4 years, and the moment you deploy it, every other miner on Earth is working to make your machine worth less. This is a video about what it actually costs to mine Bitcoin, not the idealized version you see in a profitability calculator. The real version, the electricity bills, the hardware depreciation, the mechanism hidden inside the protocol that automatically penalizes your success, and the precise set of conditions that separate the operators who make money from the ones who lose everything despite doing almost nothing wrong. Before we get into the numbers, let's reframe what you're actually buying. Because you are not buying a Bitcoin machine. You are buying a share of a lottery that pays out every 10 minutes. Here's what that means. Bitcoin's protocol produces exactly 144 blocks per day, one roughly every 10 minutes. Each block currently contains a reward of 3.125 Bitcoin, reduced from 6.25 by the April 2024 halving. The entire global mining industry is competing simultaneously for those 144 blocks. Your machine doesn't produce Bitcoin by calculating. It produces Bitcoin by winning, and your probability of winning is exactly proportional to your share of all the computing power on Earth pointed at this problem. This reframe changes everything. A lottery share with a fixed payout schedule has a very different economic structure than a machine that generates output. It means that doubling your computing power doesn't double your income, it doubles your odds. And if everyone else also doubles theirs, you're back where you started. Your revenue is set not by your machines, but by your machines relative to the entire network. That relative fraction is all that matters. Hold that thought. We'll come back to it repeatedly, because it's the key to understanding why this business can fail, even when everything goes right. Let's start with the cost of getting in. At the core of any mining operation is the ASIC, the application-specific integrated circuit. This is a chip designed to do one thing: compute Bitcoin hashes faster than anything else on Earth. Nothing else will do. A graphics card, a laptop, a gaming PC, those days ended roughly a decade ago. Today, the competitive hardware is purpose-built, industrial, and expensive. The flagship units in 2024 and 2025 are machines like the Antminer S21 and S21 XP series. An air-cooled S21 XP, generating 270 terahashes per second, runs around $4,500. A hydro-cooled unit pulling 495 terahashes, the kind that requires specialized water cooling infrastructure, runs closer to $10,000. These are not consumer electronics. They are purpose-built industrial hardware that runs 24 hours a day, draws multiple kilowatts of power per machine, and generates significant heat and noise as a byproduct. A small home mining operation, say 2 or 3 machines in a garage, requires capital of $10,000 to $30,000. A mid-sized operation with 100 machines, sufficient for a meaningful share of hash rate, requires $450,000 to $1 million in hardware alone. An industrial-scale fleet of 1,000 machines or more runs into the tens of millions in hardware before you've spent $1 on the facility that houses them. Those facilities are the other half of the capital equation. Large-scale mining requires dedicated data center infrastructure, power distribution equipment to handle megawatts of draw, cooling systems to manage the heat, network infrastructure, physical security. An industrial facility hosting 10 megawatts of miners, roughly 2,000 to 3,000 machines, can cost $3 million to $10 million to build from scratch. Most independent miners skip this by using hosted mining services, which provide the facility infrastructure in exchange for a monthly fee bundled into the electricity rate. But those services exist at scale too, and they're not cheap. When you factor in hardware, infrastructure or hosting, initial working capital, and electrical connection costs, a serious mid-tier mining operation, 500 machines, industrial power, requires $3 million to $6 million to launch. That's your entry cost. Keep it in mind. Now here's what catches almost everyone off guard before a single Satoshi arrives. First, permitting and power. An industrial mining facility is a large electrical load, often 5 to 50 megawatts or more. Connecting that kind of load to the grid requires utility approval, engineering studies, equipment upgrades, and in many cases months of waiting in a queue. Connection timelines of 12 to 18 months are common for large industrial loads in constrained grid areas. In the interim, you own hardware that's depreciating in value and not generating revenue. Then there's the electrical infrastructure itself. Running sufficient power to a mining facility, transformers, switchgear, PDUs, breakers, runs $500,000 to $3 million depending on scale. And that cost often falls on the operator. If you're building in an area without industrial power already in place, that cost alone can rival the hardware cost. In the United States, Bitcoin miners must navigate a patchwork of state-level regulations. Some states, Wyoming, Texas, Montana, have explicitly passed crypto-friendly legislation, including sales tax exemptions on mining hardware and favorable treatment for mining operations. Others have imposed moratoriums or additional regulatory requirements. Understanding which jurisdiction you're in before you sign a lease can be worth hundreds of thousands of dollars in taxes. Wyoming, for instance, was the first state to exempt ASIC hardware purchases from sales tax, a savings that can run into six figures on a large hardware order. The final pre-launch cost that most people underestimate is mining pool setup and firmware configuration. Mining pools, which are how virtually all miners aggregate their hash rate to smooth out the variance of the reward lottery, charge ongoing fees of 1% to 4% of revenue. That's not a pre-launch cost exactly, but selecting the wrong pool or the wrong fee structure on day one can silently drain returns for the entire life of the operation. So you're operating. Let's talk about where the money actually comes from. Revenue in Bitcoin mining flows from three distinct streams, and they are not created equal. The first is block subsidies. This is the 3.125 Bitcoin awarded, with every block split proportionally among pool participants based on their share of the pool's hash rate. This is the primary revenue engine. At a Bitcoin price of $100,000, a block subsidy represents $312,500 in new Bitcoin created and distributed every 10 minutes across the entire global mining industry. Your share of that is precisely your hash rate as a fraction of total network hash rate. On a practical level, a single modern Antminer S21 XP running in a pool at current network difficulty earns roughly $8 to $10 in net daily revenue at a Bitcoin price in the $100,000 range. Across a 500 machine fleet, that's $4,000 to $5,000 per day in gross revenue before electricity costs. The second revenue stream is transaction fees. Every Bitcoin transaction includes a fee paid to miners for including that transaction in a block. During quiet periods, transaction fees represent 1 to 5% of total miner revenue, a modest supplement to the block subsidy. But during periods of high on-chain demand, fees spike dramatically. Some blocks mined during the Runes protocol launch in April 2024, which coincided with the halving itself, contained fees exceeding 10 Bitcoin per block, more than 3 times the subsidy. These spikes are meaningful, but they're not consistent revenue. For planning purposes, most operators model fees as a small bonus on top of the block subsidy, not a reliable primary income stream. The third revenue stream is available only to larger operators, demand response payments, and grid services. Industrial mining facilities in deregulated electricity markets, particularly Texas's ERCOT grid, can participate in demand response programs, where the grid operator pays them to curtail their mining load during peak demand events. In extreme weather periods, when Texas power prices spike to hundreds of dollars per megawatt hour, a mining facility that can reduce its consumption on short notice can earn more in a single afternoon of not mining than it would have earned in a week of full operation. This is a sophisticated revenue layer that residential and small-scale miners cannot access, and it's one of the structural advantages that large industrial operators hold over everyone else. Now let's talk about what this operation costs to run. Electricity is the overwhelming dominant cost in Bitcoin mining. Depending on your setup and scale, electricity represents 75% to 85% of total ongoing operational expense. Everything else, labor, maintenance, cooling, pool fees, insurance, sits on top of that core power bill. And here is where the math becomes unforgiving. Electricity is also the variable that separates viable operations from unviable ones by a factor of 3 or 4, based on nothing more than geography. The average U.S. residential electricity rate in 2025 ran roughly 16 to 20 cents per kilowatt hour. At those rates, a single Antminer S21 XP drawing roughly 3,600 watts costs about $415 to $520 per month to run. At a Bitcoin price of $100,000, that machine earns perhaps $270 in monthly revenue from pool participation. You are losing money by a significant margin, every month, guaranteed. Residential Bitcoin mining in most of the United States is not a business. It's a hobby with a negative return. Now contrast that with industrial rates. In Texas, major mining facilities can secure wholesale power purchase agreements at 4 cents to 0.0 cents per kilowatt hour through ERCOT's deregulated market. In Wyoming or the Pacific Northwest, access to hydropower can bring rates to 3 to 6 cents per kilowatt hour. Hosted mining services operate at 7 cents to 8 cents per kilowatt hour all in. At 7 cents per kilowatt hour, that same S21 XP costs about $183 per month to run. That machine now generates a positive return. Same hardware, completely different business outcome. The electricity rate is not one factor among many. It is the central organizing fact of whether a mining operation can survive. For a 500-machine industrial operation in a favorable location, the monthly cost structure breaks down roughly as follows. Electricity at 7 cents per kilowatt hour runs approximately $190,000 per month. Hosting facility fees or facility operating costs add another $15,000 to $30,000 per month. Hardware maintenance, repair, and parts. ASICs have fans, control boards, and power supplies that fail regularly. Add $10,000 to $25,000 per month. Pool fees at 2% of gross revenue subtract another $2,500 to $3,000 per month. Total monthly operating cost, approximately $220,000 to $250,000. Monthly gross revenue at $100,000 Bitcoin, approximately $150,000. The spread between those two ranges, that thin zone where mining is either slightly profitable or slightly underwater, is the entire game. There is almost no margin for error, and the error usually comes from a place the profitability calculator doesn't show you. Here is the part that changes everything. Buried in Bitcoin's code is a mechanism called the difficulty adjustment. Every 2016 blocks, roughly every 2 weeks, the Bitcoin protocol automatically recalculates how hard it is to mine a block. If miners have been producing blocks faster than the 10-minute target, difficulty increases. If they've been slower, it decreases. The adjustment is self-correcting, automatic, and ruthlessly precise. Its purpose is to maintain the 10-minute block interval regardless of how much computing power is pointed at the network. Here's what this means for your business. When you buy a machine and deploy it, your revenue is based on the current difficulty. Your share of current network hash rate translates to a calculable daily income. But the moment you deploy that machine, you contribute new hash rate to the network. 2 weeks later, the protocol sees that blocks have been coming in faster than 10 minutes. Difficulty rises. Every other miner's income falls proportionally, including yours. This is the structural risk that has no parallel in any other business category. In a normal manufacturing operation, adding capacity increases output. In Bitcoin mining, adding capacity increases competition. The prize is fixed. More competitors means each competitor earns less. And new miners keep arriving, because when Bitcoin's price rises, new capital flows in, new hardware gets deployed, hash rate climbs, and the difficulty adjustment erases the advantage within 2 weeks. The difficulty has been on a nearly unbroken upward trend for almost the entirety of Bitcoin's history. In July 2024, network hash rate reached approximately 600 exahashes per second. By July 2025, it had grown to roughly 900 exahashes per second, a 50% increase in 1 year. Every miner who entered in 2024 at 600 exahashes found that by 2025, they were competing for the same prize with 50% more total competition. This is not a bug, it's a feature. It's working exactly as Satoshi Nakamoto designed it. But it means that Bitcoin mining has a structural floor under revenue that can only be maintained by one of two things: Bitcoin's price rising faster than difficulty, or your hardware becoming obsolete and needing replacement before everyone else's does. The difficulty adjustment is the trapdoor beneath every mining operation, and it opens on a 2-week timer. And then there's the halving. In April 2024, the Bitcoin block subsidy was cut in half, from 6.25 Bitcoin per block to 3.125 Bitcoin per block. Every 4 years, this happens. Every 4 years, the guaranteed per block revenue falls by half, overnight, with no adjustment period. Miners who built their financial model around 6.25 Bitcoin per block found their revenue cut in half in a single moment. Hardware that was marginally profitable the day before the halving became unprofitable the day after. The next halving arrives in 2028, when the subsidy drops to 1.5625 Bitcoin. Every mining operation operating today is already running a clock down to that date. Core Scientific is a story almost no one in the mining industry wants to tell, because it shows exactly how these structural risks interact. The company was founded as a Bitcoin mining and hosting operation, and by 2021 it had grown into one of the largest publicly traded mining companies in North America. It operated data centers across Texas, Kentucky, Georgia, and North Carolina, with a combined computing power representing nearly 10% of the U.S. Bitcoin network's total hash rate. In July 2021, Core Scientific went public through a space merger at a valuation of $4.3 billion. The business case was straightforward. Bitcoin was trading near all-time highs. Mining revenue was strong. The company deployed the cash from its public offering, approximately $195 million, into new hardware purchases and infrastructure expansion. It took on additional financing, borrowing heavily to build new facilities and scale its fleet. The math at the time worked. Revenue was flowing. The model looked durable. Then 3 things happened simultaneously, and that's the point. It only takes 3 things. First, Bitcoin's price collapsed. Bitcoin fell from above $69,000 in late 2021 to around $16,800 by late 2022, a decline of roughly 75%. Core Scientific's revenue was denominated in Bitcoin. At $69,000, every block reward was valuable. At $16,800, the same block reward produced 1/4 of the dollar revenue. Second, the Russia-Ukraine war drove energy prices sharply higher in early 2022. Core Scientific's electricity contracts, which had been structured around lower price expectations, were suddenly exposed to elevated power costs. Between July and September 2022, per the company's own SEC filings, significantly higher energy prices materially increased its cost of operations at the precise moment revenue was falling. Third, the global network hash rate continued to grow, because new hardware that had been ordered at higher Bitcoin prices was still being deployed even as prices fell. Difficulty kept adjusting upward through much of 2022, squeezing miner revenue further. The result? Core Scientific recorded a net loss of $434.8 million for the 3 months ending September 30, 2022, compared to a net loss of just $16.6 million in the same quarter the prior year. The company's market capitalization, which had stood at $4.3 billion in July 2021, had fallen to approximately $78 million by the time it filed for Chapter 11 bankruptcy on December 21, 2022. A decline of more than 98%. Total estimated liabilities at the time of filing, $1 billion to $1.3 billion. The company did not fail because its machines broke down. It did not fail because of fraud or mismanagement in the conventional sense. It failed because it had taken on fixed financial obligations, debt service, equipment leases, facility costs, during a period when revenue was high, and then 3 independent external variables moved against it simultaneously. The fixed costs didn't move, the revenue did. Core Scientific emerged from bankruptcy in January 2024 after a restructuring that converted $400 million of debt into equity and eliminated much of its loan burden. It survived. But the equity holders who bought in at that $4.3 billion valuation were largely wiped out. The stock traded at 8 cents per share in early 2023. That is what the structural risk of Bitcoin mining looks like when it materializes. Let's run the numbers on a mid-scale operation. Same 500 machine fleet. 2 scenarios. In the good year, Bitcoin trades at an average of $100,000. Your 500 Antminer S21 XP units, each running at 270 terahashes per second, give you 135,000 terahashes per second, roughly 135 petahashes. At a network hash rate of approximately 900 exahashes per second, your share of daily block rewards is about 0.015%. Daily subsidy revenue across the whole network at $100,000 Bitcoin is approximately $45 million per day. Your 0.015% share, roughly $6,750 per day, or about $204,000 per month. Add transaction fee income at 3%, another $6,000 per month. Total gross monthly revenue, approximately $210,000. Monthly operating costs. Electricity at 7 cents per kilowatt hour runs $190,000. Maintenance, pool fees, hosting overhead, $30,000. Total monthly cost, $220,000. Net monthly profit, approximately negative $10,000. You are barely underwater. Wait, but in a good year, Bitcoin is at $100,000, not $80,000. Bump the average to $105,000, and the revenue rises to $220,000. Net monthly profit, roughly positive $10,000 to $20,000. Annualized, $120,000 to $240,000 on a $3 million hardware investment. A return of 4% to 8% per year before your hardware depreciates. Now the bad year, Bitcoin averages $70,000. Same machines, same hash rate, same difficulty. Daily subsidy revenue across the network drops to $31.5 million. Your share, approximately $4,700 per day, or $141,000 per month. Fees add another $4,000. Total gross monthly revenue, $145,000. Monthly costs stay approximately the same. Electricity and fixed overhead don't care what Bitcoin is worth. Net monthly loss, roughly $75,000 per month, or $900,000 over the year. On a $3 million hardware investment, you've lost 30% of your capital in a single year, in cash, not on paper, while your hardware has also declined in value. The difference between a good year and a bad year at this operation, measured by the distance between the two outcomes, approximately $1 million to $1,100,000. That's the gap. That's not a number you recover from quickly. And it arrives not because you made a mistake, but because the Bitcoin price moved. So why do serious, sophisticated, well-capitalized operators still do this? The answer is not what most people expect. For large operators with access to very cheap power, wholesale rates of 3 to 5 cents in deregulated markets, the economics are structurally different. At 4 cents per kilowatt hour, the monthly electricity cost on that 500 machine fleet drops from $190,000 to roughly $110,000. Profitability is achievable at Bitcoin prices well below $100,000. The margin of safety is real, but that electricity rate is not available to most people. It requires long-term power purchase agreements, direct utility relationships, or co-location near generation sources. It's a competitive moat, not a commodity. There's also a tax structure argument that sophisticated operators find compelling. In the United States, ASIC miners qualify for bonus depreciation, allowing operators to deduct a significant portion of hardware cost in the year of purchase, which can dramatically improve after-tax returns in profitable years. A fleet of machines purchased for $3 million may generate a first-year tax deduction of similar magnitude, offsetting taxable income from other sources. For high-net-worth investors or profitable companies looking to reduce tax exposure while gaining Bitcoin exposure, Mining can serve a dual purpose that pure Bitcoin purchases cannot. And there is the Bitcoin accumulation argument. When mining works, it produces Bitcoin at a cost below market price. Industry analysts and operators who track production costs consistently estimate that well-run industrial miners with access to sub-$0.07 electricity are producing Bitcoin at a cost of $32,000 to $55,000 per coin in electricity and overhead alone, as of mid-2026. If Bitcoin is trading above $100,000, those operators are accumulating a dollar-denominated asset at a 40% to 65% discount to market price. That is the clearest version of the bull case for mining. It's not income, it's acquiring Bitcoin cheaper than you can buy it on an exchange. But that argument only holds while the spread between production cost and market price remains positive. When that spread compresses, when difficulty climbs faster than price, or when the halving hits and doubles your effective production cost overnight, the accumulation advantage disappears. Let's return to where we started. You are not buying a Bitcoin machine. You are buying a lottery share, a precise, mathematically defined fraction of a fixed prize pool that pays out every 10 minutes. The prize never changes. Only the number of competitors does. And the protocol was specifically designed to ensure that as competition grows, revenue per competitor falls, always, automatically, with the precision of a Swiss watch. That is the elegant brutality of Bitcoin mining. The algorithm that makes the network secure is the same algorithm that makes the mining business structurally hostile to new entrants. Every dollar of computing power you add to the network makes every other miner's computing power worth slightly less. At scale, this creates a race, a constant, accelerating replacement of old hardware with new hardware, a perpetual exodus from high-cost electricity to low-cost electricity. A relentless pressure toward industrial scale, and away from individual participation. The miners who survive long-term are not the ones with the fastest machines. They're the ones with the cheapest power, the lowest debt, and the financial runway to outlast the bad years. Because the bad years are coming, as reliably as the halvings are, built into the protocol, like a countdown timer, ticking down to the moment when your revenue gets cut in half, while your costs stay exactly the same. That's what you're really buying into. Not a money printer, a competition, governed by math, that never stops. And every 2 weeks, it recalibrates against you. The machine doesn't produce Bitcoin. The machine makes a bet, and the house adjusts the odds automatically, on a schedule published in the original code, for as long as Bitcoin exists.